Hello and welcome to this very special interview here on Money Paathshaala. Joining me today is an industry veteran, Sandeep Bagla, who's the CEO of Trust Mutual Fund, but that's only part of his life story. He has been at multiple places, seen India's financial markets very, very closely. Today, however, we are going to talk to him about debt mutual funds because Sandeep's firm, Trust Mutual Fund, which he heads, is solely focused on debt mutual funds. And there's been a lot of debate around whether debt mutual funds will even survive post the recent tax changes, which came up just before March 31st in the budget amendments. So let's try and understand that debt and debt mutual funds, how are they going to look in the future? And I couldn't think of anyone better than Sandeep, who has, taken the plunge to say that, look, we need to deepen India's fixed income market. And, we all talk about mutual funds as equity, but there's more to investing than just equity. It's always good to have an asset allocation. Sandeep, thank you very much for taking time out. My first question, which I think I've already asked, but how do you see pure debt mutual funds surviving or thriving from here on? What is your view?
Thanks, Vivek, for inviting me and giving me this opportunity to clarify on number of issues. Uh, you know, while there was a tax incentive for people who held debt mutual fund investments for more than 3 years, there is a large amount of investor money which comes in and goes and is not looking for the tax benefit. So if you look at corporate treasuries or the bank money or some of the high net worth individuals, they do not necessarily uh, wait for 3 years to stay invested. See, there's a big discussion that whether one should invest in FDs or one should put money in debt mutual funds. And my point of view has been that, it's not one versus the other. It is one and the other. While bank FD is safe, bank FD is slightly inflexible in the sense that, there could be a penalty when you take your money out. Also, a bank FD will give you a fixed interest rate return. On the other hand, a debt mutual fund, since it's open-ended, it gives you equal liquidity. Most of them are investing in extremely high-rated bonds, so it's as good as the safety, or maybe perhaps the better than the rating of the bank that you are investing in. And when interest rates come down, and they do come down periodically, then one can generate capital gains as well. So if you were to look for the last 3 months returns in most of the debt mutual funds, I think they would be in the range of 10 to 12% annualized. Now, you could say that, I would have got 7% or 7.5 on my bank fixed deposits. But here, there has been an opportunity where you got something like 10 to 12%. So there will be timely opportunities in mutual funds. And on the balance period of time, you will get the portfolio yield. So I think it's not a question of one versus the other. I think both are good supplements to each other. They are complementary. And while the wealth community might hesitate to allocate funds to debt mutual funds initially because of the lack of tax benefits, I think some of them are coming around as they are seeing the merits of debt mutual funds, which are beyond the tax benefit.